Hello, everyone. So this is going to be our first tutorial of the semester. We're going to be doing the financial instruments, associates, and a little bit about consolidation. Okay, so just to begin a little bit about the class, ACCO420 is super different than any other class that you've done, like in regards to financial reporting. So, Comp 217, journal entries. ACCO310, more looking at the financial statements. ACCO320, you're looking at the assets and the liabilities and equity section, specifically all the balance sheet. This class, we're doing more of a higher level view of kind of like intercompany transactions. Okay, so this chapter that we're going to do today, the chapter 1, it's really taking a look at the basic building blocks of the class. And just as a little example here, we're going to divide this chapter into non-strategic and strategic investments. The non-strategic investments, this is pretty much the only place we'll see it, but the strategic investments, they will pretty much carry on with us for the rest of the semester. So chapter 2, 3, 4, and 5 will be your parent and subsidiary relationship, which we will take a look at when we get there. And chapter 6 is going to be the associates. Okay, chapter 5 and 6 are obviously after your midterm, so don't worry about that too much yet. Now, this class is super particular in the fact that you can't really miss a chapter. It's cumulative, meaning your chapter 2, you're going to need some stuff from chapter 1 to be able to answer. Your chapter 3, you definitely need that chapter 2 knowledge to be able to solve it. And definitely for that chapter 4, you need your chapter 2 and 3 in order to solve a chapter 4 question. So without chapter 3, you're going to have a gap in your answer, so you won't be able to solve it. Okay, and actually, guys, for your post midterm, your chapter 5, it's actually just repeating chapter 3 and 4 on a higher level. Okay, so I don't want to scare you, but I'm just letting you know this because it's really important to stay on top of the material and to just have a plan for yourself to, stay on top of the class, do the practice problems that the teacher posts, and just make sure you're on top of the material. Don't let it pile up because, it will bite you in the butt at the end of the day. So ACCO420, let me tell you, like, it's not that hard of a class. But because of what I said, if you fall behind, it will become one of your hardest classes. Okay, so again, make sure you're on top of your material and you'll be definitely in room for success. So let me see here. The schedule that I saw for you guys this semester is that on October 1st, sorry, not October 1st, October 7th. Okay, October 7th. This is when you're going to have your case 1 and your midterm will be on October 24. Okay, so I really structured the schedule this semester in a way that we will be able to get through the material in a timely manner. For example, by October 2nd, we're going to be doing chapter 1, 2, 3, and a case review. So you should be well prepared for this chapter right here. Now, the midterm, you will also have chapter 4, which is why we're going to do that the week after we do the case review. Okay, and of course, we're going to be doing 2 midterm reviews. So little hint for you guys, they're really relevant questions, if you get what I'm saying there. Okay, so we will be doing those 3 hours each. We'll find some time for the second one, but the first one I already posted the date when that's going to happen. Okay, so that's just a little bit of planning about when everything is supposed to happen, a little bit about the class, and I already posted a little bit about me, so you can take a look at that to see how I got to this and who I am. But anyways, let's get started with ACCO420 chapter 1, just to see what in the world is happening here, right? And for those of you that have Campbell Miss Campbell, Professor Campbell, make sure to try to watch some of Professor Fairman's videos if you can, just to let you know. Vanessa is really good, but Gail, I think she's just amazing. She's the one, if you didn't know, she wrote the textbook. She sits on the CPA board. So she prepares cases for the CPA order, which is, the cases that we will be doing at the second part of this tutorial. It's some of her old midterm cases. Okay, so they're very, very relevant for your midterm and for some case practice that for your case one that's going to help. Okay, so just try to sneak into her class if you can, but if not, just come to the tutorials, you'll be fine. I'm going to be doing it more of Gail's method because that's actually what I think is a little bit better for you guys. Okay, so let's start with the chapter 1 here. We're going to be starting with non-strategic investments. Okay, and just to explain a little bit, what is non-strategic, what is strategic? We're really looking here about how one company is going to be investing in another company. Okay, what type of relationship will they have together? Now, you know that most companies, they have some random investments that they have on the side, and it's really just there to make money, right? Just there to make some higher returns, need some more money. I have excess cash on hand, and let me invest it to make more money, right? So these type of investments, we're going to call them non-strategic, meaning we're not acquiring these companies in order to further our goal for the business. We're not doing this in order to kind of acquire a supplier so we have a better supply chain, or maybe acquire a major customer so we can have a smoother transition when we're selling the goods to them, right? So that's kind of the difference between the strategic and non-strategic investments. Now, the way for companies to invest to get those higher returns is, you guys know the basic cash, just pay cash and you're going to get some investments. You can have a contract, which we've seen that in ACCO420, some accounts receivables, bond investment, or loan receivables. Okay, and that's kind of like a promise to get cash at a later date. You can also have something like an option or a future. And if you guys know that little COM308 diagram, and I'll just open a little draw here, you have this kind of line, that seems a little familiar. This would be something like your exercise price, right? Or you can also call it the strike price. And pretty much anything above this line and this point, this will start making you money, right? So you're always going to take, let's say this is X, I will take X minus $10, and that will be my gain or income generated from this option. Okay, so again, we've done that in COM308. Not that big of a focus in this class, but again, could just be some random theory, not really tested commonly, but again, just to have it out there for you guys to know. Now, you can also have an investment of shares in another company, and this is the big one for ACCO420. Okay, now, what are you doing when you're investing in another company with shares? You're buying their common shares, preferred shares, etc. What are you trying to achieve? Well, number one, I'm hoping they're going to pay me some sort of dividend, right? Some end of the year dividend, or maybe they're paying a few in a year. And that's obviously just going to be nice cash flow into my bank account. The other method to do this is with capital gains. And this is a little bit of a tax term, but don't worry, we don't do too much tax in this class. Just a little bit with chapter 3. But anyways, capital gains is when we really just sell our investment for a higher purchase price, a higher price than our purchase price. So for example, let's just tune this down a little bit. Let's say I go to the market, I go on my trading website, whatever you guys use, like Wealthsimple or easytraders.com, whatever. I see the prices of all the public companies out there on the Toronto Stock Exchange or New York Stock Exchange. Let's say I want to get some Apple shares. They cost, I don't know, $100 per share. Okay, $100. This is my purchase price. Okay. Now, if I sell them for $200, or let's say $250, so we don't have the same number, well, I just made a capital gain of $150, right? $250 minus 100. And of course, for tax purposes, that will be a TCG of $75. In case you guys are doing some 440 on the side, you guys will know what I'm talking about here. Okay, so this is what you're trying to earn, the capital gains. This is super nice for you. But of course, it could go in reverse, right? This could also end up being $50 and you have a capital loss of 50, right? So anyways, you're trying to really achieve these two things from when you're buying the shares of another company. That's the way for you to make some sort of income from that investment, okay? Now, these non-strategic investments, we're going to be always starting with something called a presumption, okay? Now, guys, a presumption is literally, the name implies, it's not concrete. It doesn't mean, okay, when I see this, this is absolute truth. Okay, so what does this presumption say? And then I'll explain a little bit about what I meant there. The presumption states that when you own less than 20% of the shares of a company, we treat that as a non-strategic investment, and we call that a financial instrument or a financial asset. Okay. Now, how is she going to trick you? She's going to pull up a case, right? And she's going to give you something like, oh, this guy has 15% ownership in the company. And you'll say, well, this presumption, well, look at that. 15% is less than 20. And therefore, I have a financial instrument. That's your first point. That's how you start. But then you say, hold on, let me look at those qualitative factors. Okay, those qualitative factors. Okay, guys, this is the money. And that's kind of what I was talking about before, the major supplier, the major customer, right? If I have BOD members, am I financially invested in them in other ways? Maybe I'm, guaranteeing their mortgage, or maybe I have some sort of debt that I loan them, or maybe I have some sort of tech that I installed in their company, and they're a little bit reliant on my company, right? So anything like that, a qualitative factor like that, would kind of ring some bells in your brain there and tell you, look, this 15% is throwing me off here, because the qualitative factors are leading me to believe that this is not a non-strategic, where it's in fact a strategic investment. I actually care about this company. Okay, I have a relationship with this company that's more than just, I'm investing in you to make money, right? If I'm investing in a supplier, I'm not just investing to make money. I'm investing to facilitate the supply chain, get better prices, et cetera, right? So at that point, you really have to be careful for the cases. And again, we'll see that the second portion of this tutorial, but that's really important to kind of separate, okay, the presumption, which is what you begin with, and then the qualitative factors. Okay, so you have to use both of them together to kind of come to your conclusion. Now, financial liability, not really going to go over it. You have it here in the recording, but anyways, it's just the reverse of this. You're looking from the lender perspective. Okay, so just take a look at that. Not really important, but this is important. Okay, so let's take a look here. Like, how exactly are we going to kind of, I guess, numerically find the solution to a problem like this? Okay, because they could put some numbers there and just ask you a quick question. And again, we will do a few questions today to, solidify the material. But we're going to be looking today IFRS and ASPE, and we'll see a few different methods that we can do for a non-strategic investment. Okay, so let's say initially, I open my investor website and I say, look at that. I'm seeing Apple shares trading right now at $5 per share. By the way, if this ever happens, you better buy it, right? If you see Apple shares for $5, something's wrong. Okay, so let's say I get some 50 shares of that, $5. So of course, my fair value at that point is $250. We just multiply those two together. Subsequently, this is what's really important. What's going to happen subsequently, right? The price of the shares is either going to go up or down. Of course, the market is volatile, so you should expect something to that. And it went to $7 per share. So as you can see here, my total price now is $350. So look at that, guys. We have a gain, right, of $100. And if you look at that more closely, this increased my investment value from 250 to 350, right? Now, how do we account for this gain? Where does it go? Now, the thing with financial instruments, again, non-strategic investments, the gain will flow through your fair value of profit or loss. Okay, it's called FVTPL, fair value through profit or loss. Okay, that's what it stands for over there. This is the method that you use under IFRS. Okay, that's the standard method to use. And what does that mean, guys? Super, super simple. This gain of $100, literally, you're just going to see it on the income statement. Okay, so if you guys know your basic income statement, revenues, cost of goods sold, ops expenses, and then you guys know we have other revenues slash losses, or other revenues, other losses, or other gains or losses, whatever we can call it, whatever we want. This $100 will literally go right here, which will affect our net income at the end of the day. So it's going to be like XXX plus $100. Okay, whatever your net income is after tax, plus this $100 that you're going to add. Of course, net of tax. Okay. Now, you can also elect. Okay, and if you guys don't know what electing means, it just means I fill out some form and I tell the government, listen, I want this gain that I have here to go through something else. I want it to go through OCI. Okay, if you guys remember that ACCO420, OCI goes right here. After your net income, we have OCI. And when we add net income plus OCI, we get your comprehensive income. Okay, so let me do this so we can see those two totals. Okay, so if you do fair value through profit and loss, the gain or loss goes right here. And if you do fair value through OCI, the gain or loss goes over here. Okay. That's the only difference between these two methods. Now, why would anybody ever want to do this, right? Because look at this. Why would I want this gain to go into my OCI? Well, you wouldn't specifically want your gains to go to OCI, but what about losses, right? And the way you have to think about this, guys, is you want to have a higher EPS, earnings per share. Your earnings per share are based on your net income. So if you think about it, I want the highest net income as possible. So if I have gains, I want to put them right here. Fly into my net income, please. But if I have losses, I want to hide them in a dark corner. This nice little OCI, very convenient, right? Other comprehensive income. I want to put it right here so that it does not affect my EPS. EPS is only affected right here. This is where you do it. Okay, so this is the reason that someone would elect to go to OCI. Okay, the trick here, guys, is that this election, again, you have to do this with an election. You can't just have it happen randomly, is permanent. So let's say 1 year, I have a loss. I say, let me put this in OCI. Done. Your loss is hidden away forever. Well, it's going to come here, but not on my EPS, doesn't really appear too much, the shareholders won't really know about it. Let's just say that. But what's the catch, guys? Again, it's permanent. So that means if the next year I have a nice gain and I say, oh, let me put the gain right here so I can show my shareholders, look at this nice EPS I have. Too bad. You can't do it. Okay? You cannot do it. It's the end of the line for you. Okay, so it's really just about making that decision. And again, with the cases, we're going to take a look at how you really want to phrase this so that your prof can say, okay, I see what this guy's saying. Okay, and we'll take a look at that. Now, just a little kind of heads up for you guys. If it ever says the word held for trade, okay, you cannot elect to OCI. You're not allowed to do that. Okay, it's just a rule that we have. If it says held for trade, like the way I think about it, it's like kind of like a day trader. You know, they just do like quick trades all the time. So there isn't really a place for you to put it in OCI. I want to see that always in my net income. Okay, so just remember, don't tell me elect to OCI, or I have the option to elect to OCI if it says this. Okay. Now with IFRS, again, public companies that are, they did their initial public offering, they have to use IFRS. ASPE, we have public, but we can also have private companies, right? So some of you guys are like, wait, what? How can I have a public ASPE using company? Right, a little weird, but just think about it for a second. IFRS is not necessarily like required for public companies, only for companies that did an initial public offering, which means they offer their shares to the public. A company can go public whenever they want. They just don't have shares outstanding. Why would a company do this? Well, the bank may have required them as one of the bank covenants. They said, listen, if you want me to, give you a loan, I want you, number one, give me a current asset ratio of 2-to-1. Number two, I want you to have like audited financial statements. And number three, I want everything to be public. I want to see exactly what you're doing all the time. I want transparency, right? So it's one of the key words, by the way, in accounting, transparency. You want to see where things are going, what kind of stuff is being done. So this is very important, guys. Okay, so this is usually, it's not really, usually it's not by the choice of the company. Usually it's mandated on them by another outside force or outside entity, which is why some companies may have this. And again, at this point, some companies just decide, let's just use IFRS, even without an initial public offering, because it could be easier for us as a public company. But again, it's at the discretion of the company to do that. Okay, so again, went on a little tangent there, but again, some people are like, how could you have a public ASPE? That's how. Okay, so for public ASPE companies, nothing changes. You do fair value through profit or loss. Everything is exactly the same. The only catch here, guys, if you don't remember your ACCO420, there's no such thing as OCI in ASPE. Doesn't exist. Okay, there's no such thing. There's no other comprehensive income. There's no comprehensive income. Does not exist. So you don't have the election option of using OCI. So don't mention that if you're using ASPE, that would be wrong. What about a private company which follows ASPE? Well, think about it, guys. For that public IFRS company, we said before, hey, let me just open my trader profile and I'll buy the shares from my nice laptop, right? I can see the price of the shares. I know where they go, and all that is nice and cool for me. But private company, they don't have their information available to the public. Okay, so it's not as easy as just opening my laptop and seeing what's the price this morning. Oh, it moved by 2 cents since yesterday. Oh, it went up by $1. I don't see that. It's not available to me. If I want to know the price of these shares, I have to call up the CEO. Hey, I want to make an investment in your company. How much are you going to let me buy 100,000 shares for? and the person has to tell you, hey, give me $100,000. So we'll do $1 per share. Okay, that sounds like a good deal, right? So there's no really other way to know that other than literally doing that. And if you've seen Shark Tank, for example, you've seen that those investors, they go in there and they're like, hey, I want $20,000 for 10% of my company, right? So this is kind of like how you do the evaluation and all that stuff. So the thing is, fair value through profit loss, we have to do some sort of revaluation at the end of every year, like this thing. And the same thing for fair value through OCI. So the trick here is we cannot use these methods. We don't have the fair value, no fair value available. So the only other method that you can use and you have to use is the cost method. Okay. So the cost method is super simple. It just means, you take whatever you paid, and that's what's going to go on your investment on your balance sheet as an asset. So I paid $100,000. This is my cost. And that's what goes as an investment. Okay. Now, the catch with this one is that ASPE requires you to test for impairment if there is a reason to believe that this asset needs to be impaired. And you guys know under IFRS, it's something you have to check annually, right? Like goodwill, you have to check annually for impairment. But for ASPE, you don't have to do it annually, only when there's reason to believe. So for example, why would I ever believe that something bad happened? Well, there's bad news, right? Maybe the CEO embezzled the company and ran away. Or there was some theft, or there's a high turnover ratio because, some sort of allegation rose up and, a lot of employees are leaving. So, the accounting's not getting done. There's going to be a lot of mistakes. So you say, well, my investment's not worth 100,000 anymore. It's going to be impaired. Okay, and you guys remember the entry for that: impairment, loss, and we have the investment that will be credited. If I credit my investment, it means it goes down, right? Okay, guys, so just take a note of these different formulas that we have here, the different kind of methods, I would say. You will probably have something like this for your case that you'll have to do. Most likely these right here. This is what they like to test you on. But again, when we do the case review, we will take a look at all that. Okay, so no worries. So I think that's all I wanted to talk about for the non-strategic. And I think now is a good time to do a little example to kind of test that. Okay, so let's take a look here at this. It's kind of a basic example, but it drives the point across. And I'll tell you something, guys. If you hate journal entries, you're going to love this class because you have to do no journal entries, basically. Nothing. However, I will be doing journal entries today just to kind of help you understand what account these kind of transactions touch. Okay, is it touching revenue? Is it touching expenses? Is it an asset? Is it a liability? What's kind of happening here? Okay, so that's why I'm going to be doing journal entries today. But again, it's just kind of a learning tool for you to understand. Once you understand, you never have to do it again. Okay, so don't worry. Okay, so let's take a look at this question here. Scuttle Inc. buys 200 shares of Burke Inc. on March 1st, 2019 for $4.20 per share. Scuttle Inc. incurs transaction costs of $120. At December 31st, 2019, the market price is 5.1, and Scuttle Inc. sells the shares on February 1st, 2020 for $10.20 in total, and incurs transaction cost of $50. So they say, give me the entries to record this using IFRS 9. By the way, if you don't know this, it's like a section from the handbook. When you get into your CPA classes, you're going to be having a lot of fun reading through that nice handbook. Yeah, if you didn't know, during your exams, you're allowed to have the handbook open. So it literally tells you like, okay, I need to account for this method using XYZ. It's kind of like having your book open. Like it literally has everything you need. So really in CPA, your main issue is time. You have to balance the time with the different issues they give you in a case. So that's why they give you the book open, because they're like, oh, let's waste more time for the people. So it's just important to know your stuff. Anyways, how do we know that we're really doing a financial instrument here? We don't really know because 200 shares, is it 200 out of 500 shares? Or is it 200 out of 50,000 shares? I have no idea. Do they give me a percentage? No, doesn't look like it, right? So the only way to know is, first of all, I know the question E1-1 is really about a financial instrument. And the second thing is IFRS 9 corresponds to financial instruments. And that's kind of like your little hint to know that. Okay. And the second way that you would know is that in this question, you're not given net income or dividends. And this you kind of need for the equity method, which is for associates. We will take a look at that after this question with the strategic investments. Okay. So again, just keep that for the side here. We're going to take a look at that later. But again, you should always verify the percentages. Okay. You want to verify, is it less than 20%, right? Because this would be a financial instrument. Okay. Again, remember, this is a presumption. Always look at qualitative factors. Very important. Okay. In this question, they're not really trying to give you a case. It's just math. So again, we're just assuming it's a financial instrument and we're going to solve it that way. Okay, guys? Okay. So the first thing we have to do for these type of questions is to do the entry at the purchase date. And the purchase date here is simply March 1st, 2019. Okay. Now, we get 200 shares at $4.2 per share. So that's going to give us 200 times 4.2. That's going to give us $840, if I did my math right. Okay. Yeah, 840. So what do we do here, guys? We have to debit investment. And you have to tell me that I'm going to be using fair value through profit or loss. Okay, I need to know what type of accounting I'm doing. It's very important, guys. Okay. And my credit is simply cash. That's how much I paid. Okay, again, for 840. Simple as that. Okay. Now, this FVTPL, you might be asking yourself now, like, wait, how, like, why is it not FVT OCI, for example? Like, why did you just assume it's PL, right? The way we know is because we already have our eyes on the entire year. And we see that at the end of the year, when I have to revalue my shares, it went up from 4.2 to 5.1. So I say, well, I know this is a gain, an unrealized gain, but a gain nonetheless. So at that point, I will be able to know that I want it to be in my profit, not in my OCI tucked away in a corner, right? So this is the reason we do this method. Now for the transaction cost, very simple, guys. Don't let it trick you. Transaction expenses. And we have here cash for 120, 120. As simple as that. Now, for our second entry, this is the revaluation date. Revalue. This is always at the end of the fiscal year. Okay. It doesn't have to be December 31st, 2019. If your company year end is July 31st, 2019, that's the year you're going to take. That's the date you're going to take. Okay. So just pay attention to the question. Be careful. You might have to prorate some stuff. So it went up to 5.1. Up to 5.1. Here it was 4.2. Now, this is a little bit tricky, but I want you guys to remember, this is currently what I have on my books. Okay, I have an investment of 840. So some people, they get a little confused and they would tell me, look, I want to put investment FVTPL of 5.1. So if I do 5.1 times 200 shares, that's going to give me 1020. So they'll say, give me 1020 over here. And, maybe they'll say cash or something or whatever. This is wrong, guys. This is considered to be double counting, okay? Because we already have this on our balance sheet. This is my final value of what it needs to go to. So really, I don't need 1020. I need 1020 minus the 840. I need the difference. Okay. So be careful with that. Don't double count your numbers. Now, like I said before, this is considered to be a gain. And we are using FVTPL. So this gain, unrealized gain, will go directly to my income statement. Again, I could say income statement, specifically net income effect. Okay. Now, why did I say the word here unrealized? Guys, this gain, it's literally like a paper. It's on my computer screen. I had something worth 4.2, now it's worth 5.1. Maybe tomorrow it's worth 6. Maybe the next day it's worth 10. Who cares? If I don't cash out, I don't have the money in my pocket. Because the day after it reached 10, it can plummet all the way down to $1. Right? So you'll say, too bad I didn't cash out. So this is unrealized until you cash out. Okay? And then it will become realized. Now, I just want to say one thing here. Be careful with the dates, okay? Sometimes they'll give you something like, oh, February 1st, 2020, the market price was $6. And some people will say, oh, $6, okay, so I have to revalue from 4.2 to 6. And this is my entry. No. Look what I wrote here, guys. You revalue at the end of the fiscal year. So this is just here to trick you. Okay? We don't care about the year, like after the year end. We don't care about any of that. Okay? So keep that in mind, guys, because again, I have seen that even in my CPA class, ACCO420, this came up and they tricked a lot of people in that. Okay, so just be careful. Okay. So our last thing here to do is the selling. Okay, and we could do that down here. Sell. And when do we sell? We sell on February 1st, 2020. So that's actually my selling price. So that's fine. It's not a revaluation. It's actually a selling date. So you can sell it whenever you want. And that's fine and dandy. So what do we do here, guys? You sell, so you get cash, right? And they tell me I got 1020, so $1020. And what do you credit? What are you getting rid of? You're getting rid of the asset. What type of asset did you just have? This is my asset that I just had. Investment FVTPL. So I will credit that for 1020. Okay, that's really all the entry. And again, we have those transaction expenses of $50. I'll put that over here. 50, 50. That's it, guys. That's the whole question. Okay. Now, I just want to say something here because what if I got $1,100 and then we're going to do another scenario, got $900. Okay, so we're going to change the question a little bit. Okay, so here notice I got more and here I got less. what do we do in this scenario? I'm going to copy paste this entry because it stays the same. The numbers are going to change. Okay. So cash here now I get 1100, and cash here now I get 900. That's the only thing that changes. I'll put that. Okay, that's where we got the number. Let's put a nice color, good. Okay, but now guys, look at this. We don't balance, right? We don't balance. So can I just do this? Oh, let me put 1100 over here. No, I can't, right? And I know some people are like, wait, what's happening? Why? Well, this is my asset. Your asset value doesn't change randomly. Okay, the fair value of it goes up, but the cost of the asset, this is like your book value, it's fixed. It's this 180 plus this 840. That's how we got, look down here, 1020. Okay, so these together give me this one. I'm going to do some color coding over here. Okay, so it just happened in this question that they paid me exactly what it's worth. It doesn't have to be that way. It could be more, it could be less. So what happens if they pay more? We're off by a credit amount. This is a realized gain of $80. Okay, because on the day of sale, I have more money than I thought I would. And over here, I'm off by a debit balance. So this would be a realized loss for 120. 120. Okay. So this is really the way to kind of solve these problems. And of course, this is your income statement account that you're going to have FVTPL. So directly on your income statement, directly through your net income. Okay, so keep this in mind, guys. Super important. And, you know, this is pretty much how you do a non-strategic investment using the financial instrument method. Okay, which is pretty much the fair value through profit or loss or fair value through OCI. And by the way, what would change if you're doing fair value through OCI? Literally, the only thing that changes is this becomes FVT OCI. And all of these gains over here, this one, and this one, oh, sorry, not this one, and this one, these three, instead of going to your income statement now, they would go directly, instead of going to your net income, they would go directly to your OCI. Okay, like we saw over here, they would go right here instead of going right here. That's the only differences, guys. Okay, so pretty nice, right? Okay. So I'll leave this like that. That's pretty much the end of this question. If you have any questions about this, of course, you can ask me at the live tutorial. But now let's take a look at the strategic investments, which are a little more interesting. Okay, I like them a little bit more. It's pretty much most of the class here. So, you know, that's pretty much the main meat of the class that we're going to see again, chapters 2, 3, 4, 5, and 6. Okay. So for strategic investment, we have three main types that we're going to look at. And again, they're all based on those presumptions of how many shares you own. Okay. The three that we have here are parent subsidiary, associate, and a joint arrangement. Okay. So for the parent subsidiary, this is where we're going to do chapter 2, 3, 4, and 5. You're going to have this nice, this is, again, the meat of the class. Okay. When you have a parent subsidiary relationship, you consolidate. This seems like a big, scary word, but trust me, after we do chapter 2, chapter 3, and 4, I'm going to say, okay, not too bad. Okay. I promise. Now, if you're ever doing a case and you have some sort of parent subsidiary relationship, Guys, I cannot stress this enough. You have to have these three criteria listed and tied to the case facts. Okay. She will deduct 2 marks or something out of 25 if she doesn't see this. Okay. Because without this, you are not proving to me that you have a parent-subsidiary relationship. Okay. So let's go over them and let's see let's try to explain them. Okay. And the second half of the class, we will do a case or a couple cases where we're going to see this. Okay. So criteria number 1, absolute power to determine significant business decisions, AKA control. Okay. Guys, the key words here are absolute and control. Absolute means nobody can contest you. You are the boss. You're the king. You're the queen. Okay. You're the big boy. So the thing here, guys, it's the big decisions, the CEO, the CFO, those decisions that drive the company, you get a say, and not even you get a say, you decide what's going to end up happening in the end. If we're a teddy bear company and you decide, hey, I want to sell chocolates tomorrow, well, you have the final say. I can't do anything against you. You're the boss. Okay, so that's what absolute power means. This is the concept of control. Very important. How do you prove this in a case? We will see that at the second part. Okay, and we'll tie it to the case facts. The second criteria over here, entitled to variable returns. Okay, so variable, the whole concept of variable means risk. Okay, because it means it can go up or down. Okay, again, this one can be easily proven if you have voting shares, right? Because voting shares, the stock price can go up or down, which means you make a nice profit or some loss. Okay. And the third criteria is literally just a mix of the first two. Your actions, if I decide tomorrow I want to start selling chocolates, it will definitely influence your variable returns. What if it's a huge success? Oh my God, you're selling chocolates with teddy bears? Valentine's Day special, here we come, right? Great profit. I influence my return with my action. Or, excuse me, you're selling chocolates with your teddy bears? Contamination issue, what's going on, right? What are you doing here? We have no expertise, our chocolate sucks. Profit goes down, stock price goes down. So again, your actions influence the returns. You have to prove this. These three, you have to prove these three exist in a parent-subsidiary relationship to say that it is a parent-subsidiary relationship. Okay? So you always start with this presumption, and then you prove it with these three criteria. Now, what is the whole concept of consolidation? Again, we're going to see that in great depth in chapter 2, 3, and 4. We're going to do a ton of examples with the intragroup entries, which are everybody's favorite. The FVA table, which is a little more friendly. And again, chapter 2, we're going to do some net assets analysis there to see what's happening. Okay, but just to kind of give you a brief concept of what's happening, let's assume we have a parent and a subsidiary, and these are the assets and liabilities of both of them. When you consolidate the parent and the subsidiary, P plus S, all you're doing, guys, is you're adding 1 plus 2 equals 3. That's it. It's simple addition. So again, when I say consolidation is not that bad, it's pretty much this. If you just break it down to the core bones of what's going on, this is what's happening. Same thing, look at the liabilities. I put a negative here because it's a liability, but 20 minus with the 15 gives you the minus 35 over here for the liabilities, the consolidated. Okay. And guys, that's why I love this class. It's literally, you see this in real life all the time. Whenever you see I don't know if some of you work in companies or, you're auditing, but when you see financial statements of companies and they always say consolidated statements of company XYZ. Consolidated means let's say Coke, consolidated Coke. Coke can be consolidated with like 20 other different companies that you don't even know about. Right? Of course, they have to disclose what the companies are because they're public and the shareholders need to know. But this statement from the subsidiary of Coke will never be available to the public to see. You will only see this guy. Okay. So keep that in mind whenever you ever see a consolidated statement. You know, it's kind of interesting. It's literally what happens in real life. Okay. And honestly, guys, the only people that see these are the people that work at the companies and the tax department at the government, because of course they're going to take their cut for tax, right? So, you know, that's kind of the insider look that we have here. And, you know, we've seen that in management accounting, COM 305, ACCO 330. So, you know, you've done that already. Now, parent sub, again, we're done with that. We're going to take a way closer look at this in the next few chapters. But now we're moving on to associates. Okay. And the key word for associate is significant influence. The way I think about this, guys, this is the king. The king always has a little helper, right? Or at least the good kings do, right? The advisor, maybe the, you know, the partner can like help you out or something, give you some advice, give you some help. You can't make your own decisions sometimes, need some help. So what happens with this, I call it like the whisperer. Okay, the little helper, the whisperer. And it's kind of like someone that's saying, you know what, hey, king, queen, you should do this and this and that and that. And the king saying, I like your ideas. Yes, I will do that. So in that scenario, you as the little whisperer had some influence over the big boy, right? The king or queen there. So that's what the whole concept of an associate is. Okay, you have that significant influence. You can move this big guy over here. That's impressive. Okay. So the presumption for this method is that you own between 20 to 50%. But again, guys, they will trick you with this. They will trick you. How are they going to trick you? They'll give you like a 30%, and they'll give you qualitative factors like, oh, no representation on the BOD, working in a completely different industry, et cetera, et cetera. We're going to look at a few of them later in the second half, but pretty much things that kind of like don't make sense with this percentage. Like they give you conflicting evidence. So you're like, do I really have the power to whisper in the king's ear? Doesn't look like it. The king's ignoring me. So, you know, I'm not really helping at all. I don't have any influence. So at that point, you may be downgraded to a non-strategic investment. Okay. So keep that in mind for the cases. And the way to kind of account for this, how you're going to do the math, is using the equity method. Okay, we're going to take a look at that down here. I'll give a little example. But before that, let's do the joint arrangement. Okay. And guys, after doing this class many, many times, meaning like I tutored it many times, I've seen the trick that always gets asked with this guy over here. Okay, so I'm going to go over it today. But before that, let's just explain the concept of joint arrangement. And again, if you guys have done ACCO440, this is like your chapter 18 partnerships. Okay, it's a couple people, 3, 4, 5, however many you have, working together. They have something called shared control. Okay, the way to kind of see that they have shared control is by having this. Okay, equal split of the share ownership. Okay, 50-50, 33-33-33, or this as well, 25 times 4. You can even have 10% times 10 partners, right? This kind of scenario can only really exist by agreement. Okay, we need to sign some sort of document, some form, some legal form to tell the government, hey, we are a partnership. This is a joint arrangement. And also it's to protect each other, because let's say partner A wants to go to, I don't know, to expand to Africa. And partner B says, no, I don't want to expand to Africa. I want to stay in North America. Without both of the partners' consent and agreement, they cannot make any significant business decisions, which is kind of bad if you have very conflicting partners, right? So make sure you go to business with the right person. Okay, but this is the whole point of joint arrangement. You have to be careful there. Now, why would anybody do this? It's very common practice actually for high-risk industries, and this is to spread risk. So for example, mining, oil industries, anything that's high risk and that requires, a lot of investment, which can lead to like an unknown outcome, right? I could go to a mine, I dig and dig and dig for days, for weeks, for months, and all I get is like a few scraps of diamonds, or not even, I get gravel. Oh, what a waste. So much money. I had to bring the drills, I had to fly the crew, I had to bring protection for the gear and everything. What a headache. So much money, and we got nothing. On the other hand, you can dig for days and months, and you get some nice heavy diamonds, ruby, sapphire. Oh my God, what a gold mine. Pretty ironic because I didn't say gold, but let's say there's gold too, okay? Great mine, okay? Anyways, it's high risk. So in order to spread the risk, so I don't like spend so much money by myself, I say, hey, company ABC, let's partner up and spread the costs and also spread the rewards. So instead of one of us losing everything in a potential way to gain everything, we'll just lose a portion in a way to gain a portion. Okay, so this is why it's a way to do it. Now, when you realize you have a joint arrangement because you see these factors in a case, your job is to tell the prof if it's a joint operation or a joint venture. This is the trick that I was talking about. Okay, and they throw this every single year, again and again and again, and it's becoming so obvious at this point. ACCO420, you're going to get this as well. Okay, when you start to do those CPA classes. Now, let me tell you the biggest difference here between them. Joint venture cannot exist without a separate company being opened. Okay, there's no venture if there is no separate business. However, and guys, please pay attention carefully to what I'm saying here. If you have a separate entity, it does not necessarily mean you have a joint venture. Okay, you can have a separate entity, a separate company, but have it be a joint operations. Okay, so having that second or having that business opened up by two companies only opens up the possibility for it to be a venture, but it does not necessarily mean we want it to be a venture. Okay, how do we know the difference then? Let's say we have a separate company. How do we know the difference between these two? It depends on legality. Let me explain that. A joint operation means each partner will bring their own assets, their own liabilities. Like, let's say I open up a pizzeria, I bring my oven, and my partner, James, brings the fridge. The assets belong to each one of us. I have the oven, James has the fridge. If we ever dismantle the company, I'm going to go home and I'm going to take my oven. James is going to go home and take his fridge. Okay, each party owns their own asset, and legally owns it. On the other hand, with the venture, and this is why we have to have a separate entity, and look at this, guys. The venture itself, the company, owns all of those different assets. Okay, so if I bring the oven in, and James brings the fridge and all those other assets, we don't own those assets anymore. Okay, it's the venture, the pizzeria shop that now owns those assets. Okay, so that's really the main difference between those two, and they will test you on that. And a lot of people fall in the trap and they'll say, oh, there's a separate company here. Oh, that means it's a joint venture. Not necessarily. Okay, you will only get half the points if you say that, so be careful. And again, guys, we account for joint arrangements using the equity method. There's also another method with the proportional consolidation method, but that's not really tested in ACCO420. So yeah, don't really worry about it. But if you have any questions about that, I'll be happy to help out. Okay. Now, how the heck do we do this equity method, right? Associates and joint arrangements. Let's take a look at this little example that I have here. Okay. So the equity method works with pretty much three different aspects to it. Okay. You have your initial investment, which is what you put in originally to buy the shares. So let's say I get 100 shares for $50 per share. Well, that's $5,000. That's my initial investment. Okay, that's my beginning amount. This investment amount will go up or down with the share of profit or loss. And I'm talking here about net income or loss. I'll put that in brackets, loss. Okay, so now we don't care about the share prices anymore, guys. And that's how they'll trick you. They'll give you the share price, but you ignore it for equity method. You don't need it. Okay. So let's say the company earned $10,000 in net income. I will take my percentage. Let's say I have 30%. Okay, let's say I own 30%. You have to take your share of profit, okay, which is the 10,000 times the 30% gives you 3,000. You can see I multiply these two to give me the $3,000. That will be added. And of course, if you have a loss here, it will just be a negative number. So it goes both ways. And the last thing that we have here is the share of dividends. Okay, now guys, you're like part owner. You're sitting at the big boy table. Okay, so that's where you get a share of the profit or loss. You get to take a cut. But at the same time, if your company that you're invested in 30% gives out a dividend, it's like part of you is leaving, right? Your company is giving out money. So it's like there's now less money in the company which you own, which is why this is now a negative amount. Okay, and again, let's say they declare 5,000. I take 30% of that and I subtract that, negative 1,500 to get my ending amount. What you see, guys, is just the sum of these three together. Okay, and of course, with the dividends, guys, you decrease your investment account, but you get cash from it. Okay, so it's kind of like, I always call it, it's like a hybrid. You're like part owner, but you're also part shareholder. So you get the cash as a shareholder, but you also lose a little bit about the investment because you're an owner. Okay, so always look at it both ways, and that will help you out. Okay, guys, so that's pretty much all the strategic investments that we have. And again, let me know if you have any questions about this. It's, it's very important to understand this because, again, this is going to be your next 3 to 4 chapters, including the post midterm. And this one will be your chapter 6. So, or sorry, your associates will be your chapter 6. I guess technically they can ask joint arrangement. So both of these are chapter 6. Okay. So again, this chapter, it seems like very straightforward in that. It is, but it's the main building blocks for the rest of the class. Okay. So now, guys, let's end off today with an equity question. Okay. This is the solution, but hold on. I'm going to open up the question. I think I have it over here. Hold on. Where is it? I think it's over here. Okay, here it is. Okay, there it is. And I'm going to open up a nice new Excel for us to take a look at so we can solve it. Here we go. Okay, so let's read this question together and we're going to give it a try. Okay, now Max Inc. acquires 40% of the shares of Goraski Inc. for $80,000 in Jan 1st, 2019. During 2019, Goraski Inc. earned $50,000 and paid dividends to its shareholders of $10,000. During 2020, Goraski Inc. incurred a loss of $5,000, but continued to pay $10,000 of dividends to all shareholders. So here again, they say, give me the journal entries and also the balance in the investment account. So the balance in the investment account is kind of like what we did when I showed you the equity method, with the beginning, plus or minus the share of profit, and minus the share of dividends. Okay, so first of all, we start here, we say, look at that, 40%, this means I have an associate. Again, no qualitative factors state otherwise, right? And again, they even say here, give me the balance in the investment account. So it's kind of leading you to believe you're doing the equity method and solidifying the fact that it's an associate. Okay. So we always start with the acquisition date, which I know this question is kind of annoying. It's so lengthy here. I'll do this. I'll do this. Here we go. Okay. So over here, we can see they got 80,000 on Jan 1st, 2019. So our first entry will be on Jan 1st, 2019. This is the purchase date. We always start with this date, guys. So for this date, very simple. We debit our investment in Goraski. And you could specify here investment in associate Goraski, like that. This kind of solidifies the fact that this is not FVTPL. Okay, this is actually an associate. So we're going to be doing the equity method. And we could put here the 80,000. And of course, we credit cash because that's what I paid with. Okay. Now, during 2019, Goraski earned 50,000 and paid dividends to its shareholders of $10,000. So at the end of the year, basically, December 31st, 2019, I need to make some adjustment entries. This is end of year. Okay. And again, it could be July 31st, 2020 as well, if that's their fiscal year end. You always have to be careful with that. Okay, some questions will make you prorate the amounts. And again, we will do that with one of the cases I gave you guys. We'll do it in the second half. So we'll take a look at that there. Okay, so we have here the net income that they earned. So we're going to take a profit from that. We're going to take a cut. Now, the way to do this is we're going to take this investment account and make it go up, right? Because that's in logic with what we did all this time. But what is my credit? Is it cash? No, that doesn't make sense. I'm getting cash technically. It's a little tricky, isn't it? So I'll give you guys a second just to think about it. And I hope you guys try these questions before I solved them like this. But if you're not sure, let me tell you, we credit the share of profit. And this is basically like a revenue account. Okay, that's why when you credit a revenue account, it means your net income goes up, right? So I would put that here. And what amount would I put? Would I put 50,000? No. 50,000 means I'm greedy. I'm taking everything on the table. Am I supposed to take everything from the table? No. I only get 40% of that. I get 20,000. I get $20,000. I get 40%, sorry, 40% of the 50,000. So I get in total $20,000. Okay. So remember, guys, this is why we call it share of profit. We don't just call it profit because you get a portion. The second entry that we want to do here is for the dividends. Okay. For the dividends, we will do cash, like we said before, that's what we get. But we also want to reduce the investment account because it's chipping away from my retained earnings of the company, right? When I pay dividends. So again, they pay 10,000. But am I going to get everything? Am I greedy? No, you get 40% of 10,000. Okay, so that's how much we get. Okay, so that's our 2019 year. Let's go over here. I'll copy this. And we're going to go over here. And we're going to do 2020. Okay, which is our second year over here. So in this case now, what is the earnings that they got? Well, look at that, guys. They got a loss of 5,000. So this becomes minus 5,000. Right? So if I copy that, I get 2,000 technically, minus 2,000, right? But I'm going to put here 2,000. And something needs to change here because share of profit, wait a minute, I'm not making a profit. I'm making a loss. I am making a loss. Share of loss. Okay, so this is the loss. That's why we debit this account, which means my income goes down. And we credit our investment account, meaning our investment account goes down. As for the dividends, that stays the same. We pay the exact same amount. If we see here, we pay again $10,000. So that's all of our journal entries, actually. If I zoom out, these are all of our journal entries. But we're not done. They ask us to find the balance of the investment account. Okay, so when we do that, what we see here is that we beginning investment account. That's always going to be this purchase price that we did. Okay, and pretty much, guys, every time you see this account, investment, I'm going to have to put it here. It's going to affect this account. So what else do I see here? Oh, share of profit. Share of profit. I'm going to add here 20,000. Look at that. That's adding 20,000 over here. We also have dividends. Dividends, or you can call it share of dividend. And you can see it's a credit now, so it will be minus 4,000. And you can do here end of 2019. Add that all together, and we get 96,000. So now I want to get end of 2020. So what am I missing here? Where I'm missing the share of loss and the dividends, which are 1 and 2. So share of loss, that's going to decrease my account. And dividends, that will decrease it as well. So in total, guys, we have 96 plus the 2 negative plus the 4 negative, which gives me 90K. Okay, so let me put that and that in a little line over here. And this is our final answer, guys. Okay, so again, guys, this is really an introductory chapter to show you how things are going. But again, you will not be required to do any journal entries for this class at all. Okay, this is just, again, to show you how things work, where to go, and it will eventually help you when you have to consolidate stuff, because it will get you in the right mindset, like where do things go, how do I account of things. And this little guy over here, this question over here, it will come back in chapter 6. So it will look familiar in a few weeks. Okay. So guys, we're going to stop it there for today. I have another question prepared for you, like P1-1 and P1-3, which are pretty tough, but I think you're going to do one of them with your prof in class. So we will do the other one, the one that you don't do with your prof, we'll do that together, okay? Because I don't think you have the solutions to that, so I think it will be pretty useful. And it's a really, really tough question. It's pretty much this question with equity method, the question we did before with the financial instrument, and then some. There's a little bit of a tricky little situation there where you go from a financial instrument to equity, or I'll say here, you go from non-strategic to strategic. And it's like, how in the world are you supposed to deal with this? Okay, so we'll take a look at that next session. Okay, guys, so listen, if you have any questions, don't hesitate to reach out to me, message me, comment in the group. Be happy to help out. And that's it. All right, so good luck with everything, guys, and we'll be in touch later in the tutorials. Okay, so take care, everyone.